Dear students, as we have discussed in the previous classes, GDP is the total income of everyone in the economy. GDP is also total expenditure on economy's output of goods and services. As I told you, it is an income total, it is an expenditure total, or it is a product total. Actually, it is an income total and also a product total. Product total is arrived at by using what is known as expenditure on product. So, we can compute GDP in two ways. One is GDP is the total of income generated in the process of producing goods and services. So, it is an income total. The second method is GDP is the total expenditure on purchases of goods and services. Either you consider GDP as an income total or an expenditure total, you will get the same total. You will get the same total. So, we will calculate national income, the aggregate output, the value of aggregate output, either as an income total or as an expenditure total. Now, there are some rules, some procedures in the computation of GDP. Let us see what are these. We define GDP as, it is a repetition, we define GDP as the market value of all final goods and services produced within an economy in a given period of time. GDP is, always remember these words, 1. Market value, 2. Final goods and services, 3. Produced during a given period of time. If you are defining it as GDP within the economy. And to compute the total value of different goods, national income accountants use market value because these prices reflect how much people are willing to pay for goods and services. So, to calculate GNP or GDP, we use market value because it reflects how much persons are willing to offer to purchase goods and services. So, product total is obtained by adding together the values when it is actually purchased by the consumer in the market. Now, what about used goods? We will not include used goods produced in a different time period when calculating GNP or GDP because the values of such goods were already included in GDP. So, one rule is the definition of GDP. Second is how to treat used goods. The third one is, this is also a repetition, treatment of inventories. Actually, inventories is very important in macroeconomics. Macroeconomic disequilibrium is defined in terms of inventory accumulation or inventory depreciation. It is a point which we will see in connection with the Keynesian theory. To explain the treatment of inventories in detail, you imagine a firm hires workers to produce goods and services and pay wages for the services of this. Now the question is, how does this goods add to GDP? We consider two cases. One, suppose that the good spoils. The good spoils. In this case, wages are given when producing the goods and services. So, as wages are given but the product is perished, spoiled, there is a reduction in profits. There is no change in expenditure as no one has purchased. Total income is also not changed because increase in wages is compensated by decrease in profits. So if a product is produced in the current period and if the product spoils, its value is not included in GDP. That is very important to be remembered. The second case is, it is kept as inventory. It is kept as inventory, not sold. It will be sold at a later time period. Now, if it is kept as inventory, not sold, we assume that the owner himself purchased it. We assume that the owner himself purchased the commodity. So what happens here is, profit is not reduced as wages are given. So, wage income has increased. So, what happens? Total income increases. And higher spending on inventory from the expenditure side also increases income. So, GDP increases. So, if a product is produced but not sold, it generates income. It also generates purchases. The only difference is it is purchased by the producer himself. So in the account of inventories, we will include even finished goods. The only thing is it is not purchased by the consumers. The consumer expenditure is reflected only in those goods and services actually purchased. So, goods and services produced but not purchased by the consumers is part of inventory investment. And as I discussed earlier, it is part of realized investment. IR was defined as business fixed investment plus change in inventories. This is a point which we will discuss again and again. So if the commodity produced is spoiled, it is not part of national income, whereas it is kept in the form of inventory, it is part of national income. As it increases income, it also increases purchases. But when this commodity is sold at a later time period, the income is not included because it is a commodity produced at a later time period. And a fourth consideration is intermediate goods and value added. As we have discussed, we will include only the value of final goods and services. The reason is the value of intermediary goods and services are already included in the value of final goods and services. So if you include intermediary goods and services, you will face the problem of double counting. So we can use either the value added approach or final goods approach to solve this problem. But as I told you earlier, two types of intermediary goods are included in calculating GNB. One is business fixed investment, purchases of plant and machinery. Second is inventory investment. Then comes housing and other imputations. that is the services of owner-occupied houses. We will not pay interest to anyone, so it is not included as a market value. But what we do here is we include the value of such services as imputed value. So many types of imputations are actually undertaken by national income accountants, not only the value of owner-occupied houses, but also the values of many government services like police, military, etc. are also imputed. Also there are so many items that is not our concern. So for those services for which there is no market, that is for which there is no purchase or sale in the market, the values are imputed. The values are imputed. But remember this, we will not impute the values of illegal activities, etc., which is not considered as part of national income. That is parallel economy, and parallel economy is not part of national income. So carefully consider all these issues while you consider national income accounting.